Right. So I'm Bhushan from the Client Investment Specialist team of FSM1. And quickly to bring you today's topic on how to structure a winning portfolio. So from morning until now, you have actually heard from different speakers, different panelists, and you have gotten all the inputs, you have taken down your notes, you have taken pictures and everything. The question now is that where do we go from here? What do we do now? How do we actually take action? So this is the question that in the next 10 to 15 minutes, I'd like to help you to answer. Okay? So here we go. A suggested framework from the Client Investment Specialist team that we have, it's called the RAR framework. Simply put, it's that, what does it mean? It's that it's a framework that we could use to actually construct a winning portfolio. And it's a very basic framework, but it's a very powerful framework. What it stands for then, it's an acronym for the first R, which is assess your risk profile, asset allocation, and lastly is that to review and rebalance. And let's get directly to the first part, which is accessing your risk profile. So this, many of you have actually have seen this risk profile, you have known this, and you'll be like, Bhushan, like, yeah, I know this, yeah, okay, fine, this is the risk profile, I understand this and stuff. And even the previous panelists also have actually highlighted on the importance of risk profile. But what I like to share here, it's not exactly about the risk profile, but the importance of it hereby on the psychology part of it. Okay, why this is important, it's now. Because of all the information that you have gathered from the speakers about the market outlook, what's going to happen, you have, instead of 50-50 odds, you have actually more information of where the direction of better odds in the market. But it's still not certain, because the market does what it wants to do. The only thing that is certain is that how much money that you can lose, right? So we have clients that coming in say that, hey, this year I feel good about the market. I want to go more risk on. I want to take more risk. And then give me more better suggestions in equity. But then the year was 2021. And what happens? Everything went down after that. And the portfolio goes down by 10%, 20%, 30%, 40%. I think I see some clients here that nodding your head that you actually experience this yourself. So here it's that it's not actually a fixed thing that it's just a rule of thumb, but ask yourself first, how much money can you are willing to lose if things go bad? That is the key here. And this is just a guideline of how you can actually structure a portfolio. The importance here is that to access the scenario and psychology as an investor by using the risk profile. Once you have done that, it's to allocate your portfolio. And this part, you can actually use two parts of it, which is having a core portfolio and a supplementary portfolio. What does a core portfolio means is that the core portfolio, it's actually on a longer-term horizon where you actually go on regional. Longer-term here means that between 3 years to 5 years. Whereas on the supplementary portfolio, that's on a shorter term, that's between 1 to 3 years, and it's actually going on the best bets and also on regional and sector and also tactical plays. So today you have learned about some key investment themes, some sectors and regionals that you can actually make use of it in this. And by having a core and supplementary portfolio, let me next illustrate to you how you can actually structure a sample portfolio. So this is based on the first, the risk profile, whereby in this example, it's moderately aggressive. So 70% in equity funds and 30% in fixed income. So after you have done that, it's that to have that fixed income portion, and then the core portion, and also the supplementary portion. So here you can see that the core has the global, Asia ex Japan and Malaysia, whereas the supplementary are more on the tactical plays, and on the very far side, on the allocation part, you can see the allocation that's different. Why this is important is that because of the long-term and short-term basis of the investment entire portfolio itself. So here, I'll give you an example. This is a portfolio simulator. You can actually use the simulator for free on the FSM1 platform itself. You can actually try it out yourself, but I'll just give you an example. So here, I've constructed two portfolios based on the simulator, and this portfolio actually follows the first rule of risk profile. Okay, so in this sense, a moderately aggressive portfolio, which has 70% in equities and 30% in fixed income. But what's different here, you can see down here, it's that for the 3 years annualized, it has, one has 10% allocation in China, that is the supplementary portfolio, and another one has 40% allocation in China, and you can see the returns there. So if a person, an investor who have been too much concentrated on one single sector or one single region just because we are feeling risk on, and when the markets are not doing well and there's a drawdown of 40, 50%, then it's actually more effort that's needed, more capital it's actually needed to recover that portfolio. But if it's actually properly structured, even though it's negative, the market was down, but the negative, it's manageable, right? And then when we stretch it out on a longer term of 5 years, then you can see that on a longer time horizon, with a properly structured portfolio, even if it's heavily invested in certain sectors, if the first part of risk profile is properly done, moderately aggressive, which here it's at the 70 and 30%, then it is still a healthy percent of 6.51%. I mean, that's okay, but then you go to the second part of proper allocation in the core and supplementary, then you get your 10.9%. So I hope that this example and simulation actually helps to bring out the point that the importance of having the risk profile done, and also the second part of the asset allocation between the core and the supplementary portfolio. And last, which brings us to the review and rebalance. So along the months, along the days, along the months and quarters and years, your portfolio actually fluctuates up and down, right? And then this is the time that you actually, just like how every year, at the end of the year, we reflect the entire year. So take also this time to reflect your investment portfolio and how you can actually rebalance it. So there are some tips that you can use the FSM1 system to rebalance it. The first one is actually by using the credit system. How many actually know about the FSM1 credit system? Anyone in the audience? Do you know that any investors, current investors, you know about this system? No? Okay, I see a lot of heads shaking. And this today, I hope that you can actually make use of this system that we have. What the system does is that, what the program is, if you're invested in an equity fund, and your equity fund, for example, it's 20%, you've allocated it, and it has grown for the past 1-2 years to 40% as part of your portfolio. So now you have this additional of 20%. So what you can do is that, take out that additional percentage of it, and then switch it to a bond fund, provided it's from the same fund house. When you do this, you'll get a credit point, and once you see that some opportunities in other sectors in the supplementary portfolio, provided again in the same fund house, you can switch it from the bond fund into the equity fund. When you do this, you make use of the credit system, whereby it can help you to reduce your cost of investment. Rather than paying that usual 1.5% sales charge, you can actually use how many numbers of credit points that you have to offset it. So the details of the calculation, all that, I would not go into that now. You could actually look it up on the website itself. So the next pro tip is that the regular savings plan. Okay? So here, the cliche here, time in the market, it's versus timing the market, right? So an example here, it's that 5-year annualized return of 11.49. So in expectation is that it's not like you get 11.49 on year 1, 11.49 year 2, year 3, year 4, year 5. The real actual in the market, this is an actual example of a fund, a global fund, where you have good days, good years, and also that 2022, you see that there's a negative 21%. And 2023, market performed well. So if you actually came in 2021, immediately in the next year, you actually see a drawdown of 21%, and you need to actually make 40% to actually just to break even. But you've been in the market on the ups and downs on the market, and just by doing regular savings plan, and regular savings plan, those who are not familiar, it's the system that we use for dollar cost averaging on the FSM1 platform. You could actually write the ups and downs of the market. And lastly is that, almost at the end of my presentation, it's bringing it all together. So to recap, it's that the RAR framework. Number one, it's the risk profile. Number two, it's the asset allocation. After you have done the risk profile, the example that I gave you is that between the 70% in equity fund, 30% in fixed income. And how do you use that? Do that is that between the core portfolio and the supplementary portfolio. And three is the review and rebalancing, the third R. And then we have seen the switching system, the credit system, the RSP. Now, on the system itself, on the FSM platform, FSM1 platform, you can actually automate the entire thing. Okay, so what I mean is like this, right? So, for example, your KWSP, your EPF, when you get your salary, those who are working, it's automatically deducted. You don't actually see that money. But then after you look it up on open up your app, your iAccount app, and see like, wow, I have so much of money, right? So but you don't feel it. It's actually being done automatically in the behind. So what if you can actually create a similar structure, similar system to automate your entire investment system? And this is how you can do it on the FSM1 platform. Because we have various products, and this is how you can actually tie it up. Because a lot of times that we get questions from clients like, hi, you have so many products, but how do I actually manage it? And this is a framework that you can use to actually manage and, most importantly, automate the entire process. Okay? So the example here is that you have your salary and you have allocated certain percentage to be invested for investments. And you set up an e-mandate, which is kind of like a sending instruction that goes to the FSM1 cash account. From the cash account, you have your allocated portion to your unit trust portfolio and also your ETF portfolio. And those who are not aware, you can actually start investing in US ETFs from as low as 100 ringgit. You want to know more about this, you can always feel free to reach to us. And that's where the ETF portfolio comes in. And remember earlier, the portfolio structure of core and supplementary I've shown you, it's not only unit trust that I've shown you, I've also shown you that where you can incorporate together with ETFs. So it's a combination of both. And that's because on FSM1, we have these various products you can combine together. And for the unit trust part, you can, after you have done in the cash account, you can do the RSP into the cash management fund. It's our parking facility, which is invested in the money market fund. And from there, invest into the UT portfolio. So this entire thing, entire system, you just need to spend time to set it up once and then let it run. Because what gets automated gets done. So that's the last part of my presentation. And I'm actually from the Client Investment Specialist team. We are actually, it's a free service that actually we give to all our clients. It doesn't matter your account size, whether it's 0 or 1 million. Everybody could actually access to us for free. And we are based in 4 places. We have offices in Penang, in KL, in Johor Bahru, in Kota Kinabalu. Either you could actually set an appointment with us at the offices. You could actually give us a call, drop an email. Number one, either your current portfolio, if you are not sure what to do with your portfolio, you have invested, it's negative, it's not performing well, how to rebalance it and how to fix it, then you can actually drop us an email. Number two, if you're totally a new investor, you want to get started and you don't know how to actually use the platform, there are just so many things on that. Also, you can actually reach out to us and to discuss on how you can move forward. So with that, I wish you a good and prosperous year, and do come and find us at the booth if you have more questions after this, right? Thank you, and let's go to the fun section of Lucky Draw.